Welcome everybody to our BNI Talks webinar. My name is Steve Tenuzo, your host, and this week I've got Oleg Denishenko. He is a business broker. He's here in Massachusetts in my former chapter, BNI Taking Care of Business in Framingham, Massachusetts. And this is something we've never really talked about, which is when it comes time to sell your business, are you ready? Do you even know? I certainly don't know. So that's why we've got Oleg here. He's going to introduce himself and then talk about this really, I think, important topic that people need to know more about. So Oleg, thanks for being on today and take it over.
Thank you, Steve, for having me. Good morning or good afternoon, everybody, depending on the time zone you are. And first thing first, it's housekeeping, and put your questions on your Q&A or chat box, and depending on time permit, I'll try to answer all these questions. The full presentation is about 2 hours, but I'll try to squeeze in 45 minutes, and we have 15 minutes for Q&A. So take a pen, make a note, and be fully present. It's a lot of information for a short period of time. I'm not actually spending a lot of time on me, but just give you an idea. That's who I am and kind of my background. My name is Oleg Denishenko, and I'm 35 plus years in a small business world. I have 20 plus year business ownership experience, 7 plus year entrepreneurship consulting. I'm the owner of New Vision Business Advisors. I'm certified mergers and acquisition professional, business broker, and certified CFO. And today's topic of presentation, it's an exit on your own terms. It's a guide to selling a small or medium-sized business. And why buying or selling a small business, it's becoming a big deal today. And this is the first question for you. What's happened on January 1st, 1946? Anybody guess? And the answer is, the first baby boomer was born, and now 10,000 baby boomers retire every single day. Many of them are small business owners, and if they start selling their business at once, the market could be flooded with very nice business selling for fire sale price. But remember, business is a very illiquid asset whose value can fluctuate wildly. If its economy tanks, you can be trying to sell a white elephant. In his best-selling books, The E-Myth Revised, Michael Gerber wrote that the only one reason to create a business is to sell it. I'm not sure whether I totally agree with Gerber, but he certainly strikes a chord with many business owners. You spend years of your life sweetening the deal, nurturing the process, and pouring your blood, sweat, and tears into enterprise. And it only makes sense that when you want to leave it and retire, you want to get the most value you can from the sale. In the next 30 minutes or so, we're going to talk about how to use value drivers to make your business as valuable as it can be. We are going to talk about planning for single, most critically important financial event of your life, the transition out of your business. And this is a universal truth. Every business owner will leave their business at some point. No one is immortal. So at some point, you and I will no longer be running our company. It's inevitable. And this is a small business market. In more than 37 million small and medium businesses in the United States. And traditionally, small businesses were passed down to the next generation passively, sold with the local market or closed down. Fewer businesses are being passed down to the next generation. Owners increasingly want to extract the pension's value locked up in their business by maximizing the selling price. And this is two very important definitions I will use during all the presentation. At SDE, it means seller's discretionary earning, and EBITDA, it's earning before interest, tax, depreciation, and amortization. and it's the main valuation driver in most small and medium enterprise businesses. SD, what's included in this? It's operating profit before taxes, market salary for one owners. The key word, it's market, fair market salary, not underpaying salary that's we doing all. That's what I see. We're not paying enough as the business owners. Non-cash expenses, it's depreciation and amortization. Non-recurring once-off expenses. What does it mean? It's huge expenses, but it's happened once, and we predict not happened again. For example, a huge lawsuit or the biggest reconstruction and stuff like this. Non-business related expenses paid by the business. And you know what it's mean? It's a purse we use in any small businesses. And interest paid. So EBITDA, it's operating profit before tax plus interest paid plus depreciation and plus amortization. Business are typically valued by a multiple of SDE or EBITDA, and every business owners who plan to sell their business should try to increase maintainable SDE and EBITDA. And what's the buyer looking for? The buyer's looking for consistent financial performance, minimum of 3 years financial statements. I prefer 5 years when I do my valuation. Solid growing revenue and SD EBITDA, management independent of ownership, skilled, experienced employee, well-diversified customer base, key supplier relationship with agreements, business with growth opportunities, well-established and documented system and process, strong and sustainable market position and brand recognition, strong referral base of happy clients, effective technology that it's used to best advantage, ongoing marketing program that's worth, and this influence what SD EBITDA multiple our buyers will to pay. And action to maximize exit value. Eliminate discretionary spending in the business and adjust owner's salary to a market rate salary. Eliminate all unnecessary costs. Settle or resolve any outstanding litigation. Proactively manage pricing. Small increases in a pricing can significantly increase EBITDA. Sell off all unnecessary assets. So my question, for example, how often do you use that granite crusher? In my career as a business broker, I see a lot of companies own machinery which was rarely used. In most cases, the equipment was there's a result of a good deal or an opportunity to buy the gear at action. 100,000 piece of machinery used twice a year hardly performed to give a return on the capital. If you use things so rarely that it makes sense to rent when you need them, so sell the equipment. Put it another way. If a piece of machinery increase your profit by $5,000 and in your industry, companies sell for a multiple of 3 times earning, then it doesn't make sense to own it unless it costs less than $15,000. So if it worth $50,000, sell it and start renting when you happen to need one. You will put more money in your pocket before the sale of the business without affecting the value in any great way. Enter long-term contracts, supply distribution agreements, key customer if appropriate. Avoid long-term commitments, large IT projects, vehicle leases, property leases without no-break clause. Clean and freshen up the businesses. First impression count for a lot. Proactively manage working capital, speed up debt collections, lends terms from suppliers, groom a competent management team, general manager, financial control, sales management, etc. Keep financial and 3-year business plan up to date. Ensure annual financial statements are produced and filed promptly. Ensure no outstanding issue with the IRS. Ensure no outstanding issue with licensing. Ensure HR policies and procedures are in place with complaint contractors and employment for all staff. Ensure health and safety records, license and/or permits are up to date. Get tax planning and wealth management advice early in the process. Avoid paralysis. Fear can prevent action. Track the change made regarding COVID-19 and the financial impacts. Due diligence is coming. Prepare it now. This is a value guidelines. Rule of thumbs are not to be relied on. The best rule of thumbs are rough ballpark starting point. The worst can be baseless and very misleading. Every industry is going to have a different level of risk and required reward. So this is why rule of thumbs and asking your neighbor what they sold their business for aren't going to cut it. You need to help of experienced person who knows how to value a business. Each business is unique and each industry is valued differently based on the perceived risk associated with the streams of income. A restaurant, for example, is much riskier than an insurance brokerage, and people will pay far more for the insurance brokerage than they will for the restaurant, even if they have the same level cash flow. Buyers buy future, not past profit. Past profit may be a guide to future profit and heavily influence price. In a small and medium enterprise business must provide the new owners with a market salary and enough excess cash flow to pay for the business in a 3-5 years. Valuation reality check. So individual buyers will have limited funds to invest. 20-40% of the selling price is common. Don't expect the bank to finance the buyer unless through the SBA loan program. Sale structure of 20-70-10, where the buyers invest 20% of selling price, normally everything they have. The SBA finance 70 and the seller finance 10% with deferred payment over X months or years are possible, but 30% buyers and 20% sellers is not a common. All cash on completion is very rare. Why don't buyers have enough money? They always want to buy something bigger. If you have 250,000 business for sale, for example, the buyer will be people with 40 or 60,000 in personal liquid equity to invest. The people with 250,000 are trying to buy $1 million business. The same scenario exists with the home buyers. People with 25,000 could buy an old mobile home and live mortgage-free, but most choose to use the money as a down payment on a much nicer place to live. How we evaluate the business. Understand, first of all, very important things. That's what I hearing from the sellers when they're talking. They usually use the word potential. But you have to understand the buyers want to pay for potential. For example, the restaurant is worth more than most because there are new development being built across the street. 500 new homes. So my business should be worth way more. When a business owner tries to inflate the price of his business beyond the value that cash flow suggests, we as a business brokers call this it's blue sky, as in paying for the promise of a clear blue sky. New development or change in industry or upcoming opportunities give a buyer a reason to buy your business, but it won't affect the price. Why? Because any increase in value has to come from an increase in cash flow, and the work that needs to be done to increase the cash flow will be done by the buyer while he's the owner. It's not you. So, method of valuation. First of all, what's the purpose of the valuation? When and why should a business be evaluated? Which methods are used in valuing small business? How can other critical factors affect the value of your business? So define the purpose of the valuation. Is this for partnership? Is this for marriage or divorce? Is this for insurance, financing growth, succession planning, sale of business? For all different purposes, the value of your business will be different. Keep this in mind. And when and why I evaluate a business, be prepared for the unexpected. And what I call it, these 5D. 5Ds, it's R. It's divorce, death, disability, disagreement, and debt. That's something bad happened in your life. And when something happened in your life, you need money. And usually business, it's most valuable assets of the business owners. And then your business must be ready, this type of events. Get ready for change. Keep the information up to date. And if you can measure it, you can manage it. Learn what drives value. If you know where you stand today and where you want to be tomorrow, you can plan to get there. So it's a 3 approach and 5 different method of valuation. It's a 3 approaches. It's a market, assets, and income. And value versus price. You have to understand definition and differentiate the cost, price, and value. What is a fair market value? How do I come up with the most probable selling price? Availability of financing. Is it a factor? How does it impact the value? So the value of any market is underpinned by the availability of financing. So market approach, it's a principle of substitutions, and it sounds like this. A buyer will pay no more than which she would have to pay to purchase an equally desirable substitute. Can you find comparable? Can you adjust for all the differences? How much real data is there? Is all the data relevant? What about the marketplace? That's, I'm sure, what I'm doing when I try to evaluate the business. It's all questions I have to answer. Fair market value versus book value. It's assets approach. Most useful when the fair market value replacement cost of assets represent most, if not all, of the value of the business. Certified equipment appraisals valuable to obtain bank finance. Not useful when the value of the business is largely derived from intangible assets. And an income approach, multiples. You heard that business valued by multiple, but multiple of what? What is the right multiple? Is this art or science? And I'll tell you, it's more art than the science. What numbers can you prove? And what are you willing to show? It's a question for you as the business owners. What is a recasting? Recasting is the process of valuation. If you need more definitions, just call me after webinar, I will answer you. What are the true owner's benefits? And availability of financing is the critical factors. What impacts can it have on value? Have you ever bought a house without a mortgage? How many minivans and SUVs would be sold without financing? What you declare affect what a third party will finance. Third party means banks. What you don't declare may need to be financed by you. And what are some other critical factors that affects the value of your business? It's confidentiality, it's locations, track record, product or service, longevity, and reputation. Management, wise selling, and tax considerations. Increase revenue and profits. That's what you need to do on a value drivers, on financial value drivers. Increase revenue and profits. Sell more to same customers. Sell to new customers. Combination of the above. Review discretionary expenses and reduce or eliminate. Prepare reasonable future business projections, set goals with detailed steps to get there. Get a business valuation now. The business valuation tells you where you are now versus where you want to be X years from now. Gives you an indication of what you need to change to drive the business value up. Research tax implication of selling the business, different scenarios. Research tax implications of seller's notes and earn-outs. Again, if you don't know these terms, just call me, I will explain. Maintain steady revenue or aim for revenue growth. Market share in your industry, the higher, the better. Customer concentration, resolve and diversify. Supplier concentrations, resolve and diversify. Clean up the balance sheet, absolute and slow-moving inventory, current or potential legal issue or lawsuit, excess cash in the business, vendor financing, translate into higher business value. Organization chart with defined position, reports, lines, duties, right people for the right position, business and financial management, sales. Work on the business and not just in the business. And remember, you are the business owners. You are not a technician. Your owner's role are expanding operation, improving revenue and profit, and planning future growth. Prepare a business plan, review and update regularly, even if you don't need financing. Prepare an honest SWOT analysis as part of your business plan. Fire yourself, get employee to replace you in your day-to-day job. Make yourself dispensable, as hard as it may be. Delegate and empower. Operational manual, company general information, position-specific information, job description, duty, result expected, etc. MVGV, mission, vision, goals, and value. Who you are, why you're in a business, what do you do, what you sell, how do you do your business, and what do you want to achieve. Clean documentations, records, minutes, and financials. Audit or reviewed engagement better than notes to reader. Clean up the shop, warehouse, offices, stores. Clean up operations. Non-performing or unsatisfactory employees. Non-performing or unsatisfactory suppliers. Slow or non-moving products or services. ICO 900 certified, if not, things of benefits that might come with such certification. But I'll tell you, it's not for everybody. It's probably for the mid-sized company and up. The goal is a producer that's produce consistent result. Develop your elevator pitch, employee retention agreement, and bonuses. How long are you willing to stay on to allow for a smooth transition? Prepare for the non-financial due diligence, customer satisfaction, reputation in the market, how helpful the employee are, long-term lease with good terms and a break clause. Get advisors such as lawyer, accountant, business coach, exit planner early in the game and work with them. So what's the professionals like me can make your life easiest? What's the value we can bring it to the table? The right business broker can add significant value to your selling price. He or she can do financial recasting, research and valuation, proper documentation, marketing, buyer screening and matching, business presentation, offer drafting and negotiation, rate financial, managing due diligence process, and managing closing process. Most small and medium enterprise businesses sales have some element of earn-out or seller financing. And why should the seller finance the buyers? Number one, it will result in a higher selling price for the business than an all-cash price. It demonstrates the seller's confidence in the future viability of the business. And when the seller has a vested interest in the future success of the business, it gives enormous comfort to the buyer and gives comfort to the bank. And if the person who knows the most about the business isn't prepared to provide some funding, why should they? The true market value of a business can only be established through a combination of comprehensive marketing and competitive bidding. So that's a very interesting definition of the goodwill, and it's go back to 1810. That's what the oldest I can find. It's thanks for the internet, and it sounds like this: goodwill is nothing more than the probability that the old customer will resort to the old place, even though the old owners has gone. So it's a common problem I see. It's overvaluing goodwill. The second biggest problem, as I already said, is overvaluing potential. Potential, why it's not sellable? Because it's hypothetical and unproven. Why was it not exploited before this? And buyers rarely pay premium for the something they have to make happen. So how to source the premium exit value? Find the premium buyer by finding all buyers, not only one of them. It could be individuals, owners or managers, strategic buyers, financial buyers, and even international buyers. It's plenty around nowadays. Understand each buyer's motivations, negotiate with the several parties, be flexible in relation to deal structure, be prepared to wait. It can take up to a year to find the best buyer. Engineer competitive bids. So that's a diagram that shows how long does it take to sell on a small and medium market arena nowadays. So as you see, over half, 55% business selling probably between 4 and 12 months. So usually be prepared from 9 to 12 months. So who we are and what the businesses we sell. As a New Vision Business Advisors, we sell in owner family managed businesses. That's it's over 3 years in operation, revenue of $500,000 to $10 million, between 2 and 50 employees, market valuation $200K to $20 million. And most important, owner is committed to the sale of the business and has realistic expectation in terms of value and sales structures. And our job is to confidentially sell your business for the maximum amount in the shortest possible time frame with the least risk. So this is 5 steps I usually process the sale process. It produce a detailed valuation on the business to identify the most probable selling price. Prepare key documents. It's 1-page blind teaser for the potential buyers, and confidential business profile. Confidentially market the business. Confidentially, I will explain a little later. Screen inquiries and manage negotiations. accept the best offer and complete the sales. Confidentially is essential. We never ever publicize the name or location of the business we are marketing. You probably, a lot of participants, it's a parents. I have a question for you. What would you do if you go to the morning on a daycare and a door of this daycare it's signed business for sale? What would you do? Probably 180, turn around and run. Another question, have you ever sit in a restaurant that's in a window, it's signed business for sale? Probably never. But these businesses selling and buying every day. And it's confidentially, when it's confidentially, it's breached, its stuff become unsettled. Competition spread rumors, suppliers withdraw credit, customer go elsewhere, and on and on and on. And other key to consider, avoid confrontation. Both parties must walk away happy. You'll probably have to work together during the transition period. Work through the broker. Assets versus share sale. You have to understand the pros and cons for both parties. Keep communication channel open. Maintain momentum. Deals die if not proactively managed. Be patient, realistic, and flexible. And why use New Vision business advisors to sell your business? Because we specialize in selling small to medium-sized business nationwide. We search nationally and internationally to find the best buyer for your business. We have the skills, knowledge, systems, and experience to confidentially sell your business. We only get paid for selling the business when the business is actually sold. You only get one chance to sell your business. Remember this. So take the first step towards selling your business today. Speak with a broker in complete confidence without obligation. And for all participation for this webinar, this is today's absolutely free offer with no obligation. I'm offering you the free value of your business and a free financial assessment. I will give you the health of your business, your profitability, and the way to grow your business. It's my information. You can text, call, or email, whatever you prefer. And that's probably it, Steve. I'm probably have time to answer the questions if we have.
Well, that's good because we've got a few questions for you.
Okay.
So let's start with what is the benefit or necessity of having a valuation in the case of succession, passing the small business down to a son or daughter?
That's again, if you remember at the beginning of my presentation, the purpose of this one, the purpose is for the taxation, for the estate plan, or make sure you have the system to transfer your business to kids with everybody happy, because kids have to have finance and you have something to happily retire. So for the different purpose, the different valuation, and most important structure of the business. Because remember, you probably heard the term, name your price, I will name my terms. Terms, it's more important, even the price.
Right. Okay. Someone's asking, what is recasting?
Recasting, that's definition of the process to find out the true value. We are small business owners. We are not a public company. Public company do whatever they can doing to maximize the profit for the interest of shareholder. We, as the small business owners, doing whatever we can to minimize the profit to pay less taxes legally. So the process of recasting, the cash flow of the business producing the sales, $100. It's money on a table. It's up to me as a sellers how I spend legally my revenue to minimize the tax profit. I can spend it on my life insurance. I can spend it on my Hawaii conference. But if, Steve, you buying the business, it's up to you how to spend this 100. More, maybe reinvent to the business, maybe to use for the car for your kids. That's the process. When I do recasting, I'm asking the sellers what it's belongs to. Is it operational or non-operational? If it's not operational, I put it back to the net and then apply multiplier. That's the process called recasting. Retrieve the real non-operational and separate from the operation expenses.
Okay, great. JT is asking, JT is from Endeavor Business Brokers in Pennsylvania. He says, what are the best ways to value Main Street and low to mid-market businesses?
SD, market valuation, that's the best. Oh, as I said, between 2 and 5, we can discount cash flow, can use it with EBITDA over 5 million. It's discount cash flow, but Main Street business, it's a market approach, definitely.
Great. Okay, Judy's asking, how early should a business broker be consulted?
Probably you have to have your exit plan as soon as you open the door of your business. It doesn't mean you have to sell the business right away. It doesn't mean you have to sell your business at all, but it's a win-win situation for you and the business. The biggest mistakes that I see business owners decide when I'm ready, my business will be ready, and it's 100% not. And as you remember my presentations, I'm valuation based on historic data. Even valuations, it needs 3-year cycle. So you cannot put it 1 million sales today and value your business 5 million more tomorrow. No, it's take time. And that it's a very sad situation when I present valuation. And if the business want more, is he supposed to work more? It's not months, it's not half a year, it's probably several years in ahead. So you have to have your business ready for sale, but you don't have to sell it. And eventually you will have, this business will bring more money in your pocket.
Great. Okay. Let's JT hit enter too soon and cut off his sentence. That's why I didn't read that part of it. So let's back up. I'll give you the whole thing. My question is on valuing Main Street and low to mid-market businesses. How do you best value with an income approach? Say we do a DCF on a business. How do we best overcome not having beta to find, I don't know, what you get into, WACC/discount rate?
It's a discount cash flow method. So it's a very technique and very complicated valuation. If you'd like to talk, it probably takes more than 10 and 15 minutes. It takes probably, we can talk an hour. And because as I said, the evaluation, it's more the art than it's the science. Please call me, we can discuss it. I can help you as much as I can.
Yeah, JT, that sounds like a good one-to-one. Okay, someone's asking, how much does your service cost?
It's depend. When I'm selling the business, it's typically on our industry. We get paid on a closing table. So we're not paying until the deal is done. And it's our success fee between 10 and 12% of the selling size. But if you would like to work with me or prepare your business to be sellable and more profitable, it's case-to-case basis. That's why I name of my business, not New Vision Business Broker, but New Vision Business Advisors. I'm working like advisors.
Got it. Okay. Great. Okay. Does your business structure, sole proprietor, LLC, impact the sale of a business?
Sell not, but I have to, who is on a sole proprietorship right now, I have to say thank you very much. You pay too much taxes, you support all the rest of us. Thank you. Mm-hmm. So that no, because it's the you cannot sell sole proprietors on a share sale. It's a two, in United States, it's two type of sales, asset sale and share sales. So very rare are the share sales I see on a small and medium size because of the share or you transfer all the risk and everything that's attached to the previous owners. So in an asset sales, you just buying assets, but a legal structure, it's a new. You don't have responsibility for what's happened in the past. And yes, that it's usually if you do an asset sale, structure doesn't matter. You have to create your own. In a share sales, yes, structure it's matter because of liability. That's a major factor.
Mm.
Unless you cannot transfer some kind of specific license, government license, or you cannot transfer the lease of the premises, that's it's 100% marketability of the prime space or something, that's my recommendation, use asset sale.
Okay. Let's see. What industries do you have expertise in?
I'm on a small business world a lot. So even when I moved to United States, I had probably a dozen of the businesses. I have knowledge, a lot of industries. But from my experience, people not buying specific industry, they buying cash flow. Statistics shows that's 3 out of 5 buyers will buy totally different business that's come up in the market. Another statistic shows that 9 of 10 buyers will never buy anything. That's number one reason why the sellers need me, because I can pre-qualify these sellers about 10-15 minutes. But back to the buyers, unless they buying competitors to grow up your company overnight twice size as quickly as they can. So they buy the cash flow. And it's, from my experience, it's very rare that somebody open door in my office and telling, I want a haircut salon, or lawn moving company, something like this. The conversation starting like this. I got fired from the corporate world. My salary with bonuses probably 120, 150K. What do you have that can maintain my lifestyle? So the business had to provide 3 only numbers. The business had to pay the debt because nobody would buy cash in nowadays. The business had provide the fair market value for the buyers. And number 3, the return over investment on my down payment when I buy the business must be my recommendation, 20% on a service businesses, tangible business, 30% on a service, non-tangible business, and a high risky as a restaurant, it should be 50%. And if these 3 numbers business can support, buyer will buy.
All right. Ron's asking, how would you value a registered investment advisor and investment manager and financial planner?
That's its assessment of the risk. This is the same. What's the value? Let's put it from the beginning. Is the business is you? Mm-hmm. It's 100% you. I cannot sell people. It's it's not
because you're the
it's not legal in the United
right?
States to sell one person. So
right.
yes, that's.
But if it were a firm with other agents or something like that, then
exactly. I can recommend this system how replace you as the owner out of the business. That's the huge risk. Let's put it the shoe on a buyers. What I will get if you leave it and your clientele leave it with you. What I'm buying really.
Mm-hmm. Yeah, that's true. If you're gone, then it's a completely different business anyway, right? Okay, let's see. This person says we work with startups. What few key questions can we ask them to get them thinking about this? And would you be able to offer a similar presentation to my startup clients?
Yes, definitely. It's happened, first of all, the bank considering the buyer as a startup. So they asking the same financial documentation as a business plan, financial projection as a startup, because the buyer, it's brand new. So that's what I'm helping. I have knowledge in the relation with the probably a lot of SBA finance or financial institution banks. I know what's banks, different banks looking for the different situation. That's what I can show the how obtain financing even for startup. And the same, what's directions depending what's the owner's business owner startup wants to achieve. That's a different direction for the different purpose. Would be it's a growing through the acquisition, would be selling for the strategic buyers, would be selling for the private equity, would be selling for the private investors. All the buyers, all the financial institutions have their own requirements, and you have some kind of adjust the growth for their requirements.
Great. All right, that looks like that is all the questions we've got in Q&A today. So Oleg, before we sign off, any final words?
So the what I have to say, that's the very staggering statistic. Can you imagine how many businesses will never sell? That's it's already on a marketplace right now. And I'll tell you, it's more than 75%. So 25% will ever sell. And the number one, it's our expectation of the owner. So my final word will be get realistic price in your mind and understand what will affect.
Yeah, I think that's a good point. I think people sometimes just assume that they know what the value of their business is, but they don't factor everything in, and then suddenly it's not worth what they expect.
Yeah.
And then what do? They just shut the doors and they go away?
Yeah, I can give you, we probably have 5 more minutes. I will explain a value on a different people. It's a different view. So let me give you the very, very simple example. You will understand everybody. You go to buy the new car. You on a dealership, you see on a showroom on a floor, nice brand new car and a sticker price on it. Will you buy for this price? No, you probably negotiate it, right? So you negotiate it, you drive away, and after you drive out of the gate, will be the same price of this car? No, it's not different. You decide to return this car back to the dealership. You're coming back. Will manager take the same price that sold it? So that's my point.
Appreciation, yeah.
200 yards, 15 minutes different. The same car, 5 different value.
Wow.
And I'll tell you what, you never know why people selling, why people buying business in the first place. And money usually not in the first place. I can tell it from my experience.
Absolutely. All right. Well, I thought this was a great presentation. Gave a lot of people things to think about for their own business. So thanks for
presenting. Any questions you have, reach me out. I'm more than happy to answer all your questions if you have.
Fantastic. All right. Thanks everyone for being on today. We'll see you next week, and give yourselves a CEU for this one. Take care.